SoFi Technologies is currently trading at $28.48, down about 0.70% for the day. While many investors might glance at this small intraday dip and dismiss it as typical market noise, what's happening just beneath the surface suggests a much more interesting story is unfolding. This isn't just random fluctuation. It's a reflection of a quiet but intense tug of war between long-term believers and a growing contingent of skeptical short sellers who are placing significant bets against the company's future. The common narrative you hear everywhere is that SoFi, with its powerful brand and all-in-one digital banking app, is on an unstoppable path to disrupting traditional finance, especially with the student loan refinancing business roaring back to life. The expectation is a clean, upward trajectory as it scales its member base and achieves consistent profitability. The reality, however, is that SoFi is navigating a treacherous economic landscape where its every move is being scrutinized and its valuation is being aggressively questioned by some very large players. The stock opened this morning at $28.56 and quickly tried to push higher, hitting an intraday peak of $28.74. That brief surge was met with immediate selling pressure, driving it down to a low of $28.15 before it found some footing. This price action, contained within a relatively tight range, indicates a stalemate. The buyers are stepping in on dips, likely retail investors and funds committed to the long-term growth story, but sellers are capping any advance, preventing a genuine breakout. The volume accompanying these moves isn't explosive, but it's steady, suggesting a methodical distribution of shares rather than a panic-driven sell-off. The bigger picture is tied directly to macroeconomic forces. SoFi's core lending business, personal loans, student loan refinancing, and home loans, is exceptionally sensitive to interest rate policy and consumer credit health. While the Federal Reserve has signaled a pause in rate hikes, the current high-rate environment puts pressure on SoFi's net interest margins. Furthermore, any sign of weakness in the job market or an uptick in consumer delinquencies could directly impact SoFi's loan portfolio quality, a key point of concern for bears. This is why institutional investors are watching metrics like unemployment claims and consumer credit reports just as closely as they watch SoFi's quarterly earnings. They are trying to determine if the company's underwriting models are robust enough to withstand a potential economic slowdown. This is where the expectation of seamless growth collides with the reality of cyclical economic risk. A significant portion of the market is betting that SoFi's member base, which often skews younger, may be more vulnerable to financial stress than the customers of established banking giants. This brings us to the increasingly critical topic of short interest. SoFi has become a prime target for short sellers. The current short interest as a percentage of the float is hovering at a significant level, suggesting a substantial amount of capital is betting on a decline in the stock's price. This isn't just a few small firms. This is a coordinated position taken by hedge funds that believe SoFi is overvalued relative to its profitability and faces insurmountable competition. Their thesis often centers on a few key points. First, that the student loan refinancing boom is a one-time catalyst that will fade. Second, that competition in the neobank space is fierce and will compress margins. And third, that SoFi's path to GAAP profitability is not as secure as management projects. What should you as an investor do with this information? You can track short interest data through services like Ortex or Fintel, which provide daily updates. Pay close attention to the cost to borrow, the interest rate short sellers must pay to borrow shares. A sharp spike in this rate can indicate that the supply of shares available to short is dwindling, sometimes preceding a short squeeze. However, it's crucial to differentiate between a potential squeeze and a fundamentally justified short position. Chasing a squeeze is incredibly risky. A more prudent approach is to understand the short thesis and evaluate its merits against your own research. Do you think the bears are right about the competitive pressures, or is SoFi's integrated business model a durable advantage? To understand SoFi's potential, you need to look at its three distinct business segments. The first is lending, its bread and butter. This is where it generates the bulk of its revenue through personal loans, student loan refinancing, and mortgages. The company's ability to originate high-quality loans and sell them to institutional partners while retaining servicing rights is central to its model. The second segment is the technology platform, primarily driven by Galileo and Technesis. This is SoFi's B2B offering, providing the back-end infrastructure for other fintech companies and financial institutions to issue cards, process payments, and manage digital banking services. Many bulls see this as the hidden gem within the company, a high-margin, scalable business that diversifies its revenue away from the cyclical lending market. The third segment is financial services, which includes SoFi Money, checking and savings, SoFi Invest, SoFi Credit Card, and insurance products. This is the core of the flywheel strategy. Attract members with one product, like a personal loan, and then cross-sell them multiple other services. The more products a member uses, the lower the customer acquisition cost becomes and the higher their lifetime value. This strategy is compelling, but its success hinges on flawless execution and convincing customers to leave their established banking relationships for an all-in-one digital platform. Recent earnings reports have shown impressive member and revenue growth, and the company has finally achieved GAAP profitability, a milestone that the market has rewarded. However, the market is forward-looking. The question is no longer, can they become profitable, but can they sustain and grow that profitability in a meaningful way? This is where the debate gets heated. Bulls point to CEO Anthony Noto's leadership and the company's aggressive innovation. They believe the brand resonates with a younger demographic that is tired of traditional banks. Bears, on the other hand, point to the high stock-based compensation, the reliance on selling loans to maintain liquidity, and the fact that its technology platform, while promising, faces competition from giants like Fiserv and FIS. What is your take on the rising short interest, smart money, or manipulation? Let us know your thoughts in the comments below. The reality is likely somewhere in the middle. SoFi is not the flawless disruptor its biggest fans claim, nor is it the house of cards its harshest critics allege. It's a high-growth company operating in a highly competitive and cyclical industry, with both incredible potential and significant risks. Looking ahead, several catalysts could propel the stock higher. Continued strength in the student loan market is one. Another is the successful integration and scaling of Technesis, which could significantly boost the technology platform's revenue and margins. Any new product launch that gains traction, like an expanded wealth management offering, could reignite investor enthusiasm. On the flip side, the risks are equally clear. A recession would almost certainly lead to higher loan losses and reduced demand for credit. Increased regulatory scrutiny on the fintech sector is another persistent threat. And finally, if a larger, deep-pocketed competitor like JP Chase or Goldman Sachs decides to aggressively compete in SoFi's core markets, it could put a serious dent in its growth trajectory. Investors should monitor the company's deposit growth, a key indicator of customer trust and a source of cheaper funding for its loans. They should also watch for any changes in institutional ownership in the upcoming 13F filing season. A significant increase in ownership by reputable long-term funds could help offset the negative pressure from short sellers. Comment below how many shares of SoFi you currently hold. In summary, today's slight decrease in SoFi's stock price to $28.48 is far more than just a number on a screen. It represents a critical juncture for the company. The prevailing expectation is that of a fintech powerhouse in the making, destined to reshape personal finance. The underlying reality is a company fighting a multi-front battle against economic headwinds, fierce competition, and a formidable crowd of short sellers who are betting heavily against it. The path forward will be determined not by hype or sentiment, but by the company's ability to execute its strategy, maintain credit quality in a challenging environment, and prove that its integrated model is truly a long-term competitive advantage. Understanding this tension between the popular narrative and the complex reality is the key to making an informed decision.